So welcome to today's Learn education session, Understanding Reverse Mortgages. And today we have Shane Irwin from Fairway Independent Mortgage Corporation presenting with us. And by way of getting started, we're going to just orient you a little bit to Learn. Learn is a lifelong education and aging resource network, and we're an Idaho-based nonprofit organization with a mission to provide quality community education on retirement and age-related topics in the area of health, wealth, lifestyle, and caregiving. And Learn is also part of the Society of Certified Senior Advisors, so we are a leader network. Brief disclaimer is this content is provided for general information purposes only and is not to be considered legal, financial, or health advice. So please consult with your legal, financial, or healthcare or other service providers before taking action based on this information. And in addition today to being an incredible presenter, Fairway Independent Mortgage Corporation has also been our sponsor for this whole season of education sponsored by or presented by Learn. So in addition to being a great presenter, Shane has also put his money where his values and beliefs are. And so we'd like to thank you very much for being a sponsor as well as a presenter today, Shane. Thank you. Shane, I have to admit that in my hurriedness to get things up and running, I didn't get your bio presented. Would you mind just educating us a little bit about you and your background as we move into this presentation today?
Yeah, for sure.
Thank you.
Yeah, so I come from a background of financial advising and lending, real estate. I've kind of done the whole gamut of the business, but for the last 21 years, I've been focusing in the financial arena, and lending side of that is an important piece and tool of helping people reach their financial goals. And here at Fairway, that's really what we're about, is trying to help people have accesses to finances forever, for their whole life. We call it the retirement mortgage process. I'm a retirement mortgage specialist with Fairway, and with doing that, it's not focusing on a product. I'm not focusing on reverse mortgages, even though we're going to talk about those today. We're focused on helping people achieve their goals in retirement. And that starts when you're buying your first house. That starts when you're refinancing at 30 years old to pay off some debt, or there's no age when you want to start working towards retirement. I mean, different people start the process and what they look at retirement differently. Some people say, I want to stop working at a certain age, and that's retirement to them. Other people are, I want to work until I take my last breath. There isn't necessarily one way. But for us at Fairway, we're trying to help people achieve that. And so my bio for me is to help people achieve their goals through the different education that I've learned over the years. And that's financing, real estate, and lending. And in my background, I've kind of, like I said, touched it all, but there's nothing that really hit a chord for me any more than the reverse mortgages. Part of that is because they're so misunderstood. I personally have misunderstood them. I was an anti-reverse mortgage guy, if you will. If somebody were to come to me on the street and say, I should do a reverse mortgage, I would say, well, why? Because Tom Selleck told you, or why? I don't understand. I mean, to me, they always seem like snake oil. Like they got to be bad. There can't be good there. And so my passion has got around understanding this loan program. And it started, I think all of us have a story of where it starts for us, where we impact a product that changed our lives. Mine was when my grandfather wanted to do one. And when he wanted to do a reverse mortgage, it was 2008. And he came to me and he said, I want to do a reverse mortgage on my house. And at the time, I went to school in finance and a degree that I went to school on his dime. My grandpa paid for me to go to college. So, I should listen to this guy. On top of that, for 7 years at this time, I was a mortgage broker. I owned 2 RE/MAX franchises at the time. So I also understand real estate, and I was developing subdivisions. I had 7 subdivisions in pavement. So, I mean, this was the heart of moving and shaking for me. I thought I was pretty educated. And my grandfather said to me, I would like to do a reverse mortgage. I immediately said, why? I couldn't understand why. My grandfather's wealthy, he's a millionaire. his house is paid for. I couldn't get my mind around why. And then secondly, I was like, well, they're going to take your home. You're going to borrow like 30 grand and then you're going to die and they're going to take your home. Now, none of that was true. Not one word I said was true. I didn't know it was, I was not telling him the truth. I thought that. So my background getting into what we're going to talk about today comes from personal experience of not understanding this product at all. And I thought, if I don't understand this, how many other people don't understand this? And I think it blows your mind when you realize how many people actually do not have a clue how these loans work. And I will raise my hand and say I was one of those at one
Me too.
point. Yeah. So we're not alone. We're not alone, Dee, right?
Me 3, and I'm still trying to convince people I love.
So true. So true. We run into them every day and we're going to see it change. I think we're coming to what we call a tipping point, right? Where we're starting to see people get it, grasping and seeing a little more of the truth. And, we're in the process of writing a book, and that first chapter of my book is called Myths, Facts, and Flat Out Lies. I believe a myth. We think they're facts, but truly what we believe a lot when it comes to this product and a lot of finances is a lie. And I don't like to call out people very often, but there's one guy out there that I've lived my life by a lot of his teachings to find out that they were actually myths, not facts. His name is Dave Ramsey. And I think we've learned a lot of stuff from Dave Ramsey. I'm not saying everything that he teaches is poor, but much of it is just not the truth. And I think it takes some education to step back and look at it. For me, I won't get, super religious on this call or anything, but my favorite book is the Bible. I can't help but talk about it. I love that book. And in that book, there's this saying that Jesus says all the time. He always says, "It is written." And it's written. He says, "It is written." And you'll read it, and it's a lot in these red letters. And I don't even read those words that way anymore. I read them this way: go look it up. I think that's what he was saying. He's saying, go look it up, and he's talking to people. And the problem is I believed guys like Dave Ramsey. And he says like reverse mortgages are bad. And I could go through a lot of examples. And I didn't stop to go look it up. And I should have. And I didn't look at the facts. And by the time I learned the facts, I realized that I had actually hurt clients by telling them misinformation because I thought what I was telling them was the truth. And it just wasn't. And so I don't know if we're ready to start diving into this presentation.
Let's go.
But to me, that's really where I've come from on this. And I think it helps people understand a little bit of background is understanding that if you're a person that's going to watch this video or on this call, if you're anti-reverse mortgage, or you're even neutral, I think today you should stop and just look at the facts. Today, I'm not going to give you any of my opinions. From here forward, you've heard my opinions already. Okay, here's facts. Let's talk about some facts. And the facts are, I'm going to share my screen with you. We'll dive right into here. I like to start with a little humor because I think it's important. People come to me all the time, and if I'm saying, if our income is fixed, just how come we're broke, right? we all feel that. There's lots of people I work with every day that are on fixed incomes, but they don't feel like it's quite enough. And I think we're feeling that more in our economy now than ever before, with the facts that inflation is rising so high, the cost of goods, the cost of gasoline. I mean, you could take anything. It's so high, but our incomes aren't keeping up. I know Social Security has talked about moving up 6 to 7% this year, but anybody that's been watching Social Security for quite some time, you understand that it's the raise, that it's not ever a raise because of the Medicare that takes the raise away. And I think a lot of people are expecting that to happen again. I've heard reports that Medicare could take 4 to 5% of that increase just alone. And if that does, then really your income is not keeping up with inflation. And I like to use analogies of things that we can all understand, relate, and touch. I think a cell phone is something everybody in this call understands. It's full of tools and options, and a rotary phone right there is not. I mean, I look at that rotary phone, that's a 30-year fixed mortgage in our example. That's just a regular mortgage that most of us understand. And a lot of people understand a cell phone, but I think depending on your demographic, you might understand a cell phone a little bit differently than maybe You take a 12-year-old girl, I've had one of those. They understand that phone way better than me. And I could tell you, and I'm 43 years old. And I think that would be a big difference, even if I took my parents or my grandparents on my level of knowledge. And I think when we understand that a reverse mortgage is more complicated than a forward mortgage, than a regular mortgage. And it kind of becomes overwhelming for some people to think about it because we understand that rotary phone, we understand that phone. And I always look at the rotary phone example here to say, that will make a great phone call. If I plug it into the wall, it will make a great phone call. And in fact, probably better than the cell phone. It won't drop a call very often. I can't think of ever dropping a call on a landline, but when it comes down to that cell phone, it has some limitations on the fact that it could drop a call, yes, but I can take that away from the wall, make phone calls, right? And I can travel with it. It's a whole lot more to me than a phone. And I think it is to you too. For most people understand here, it's who owns a camera anymore? Who owns a video recorder anymore? It's our texting, you fill in the blank, it's your emails, but it's complicated. There's more to it. There's more tools. And one of the things I'd like to get out of the way at the beginning is a cell phone in relation is more expensive than a landline. I can go get that picture that I took there of this rotary phone was from Amazon. I could buy that phone for $17. I don't know why anybody would want to buy one, maybe unless you want to decorate something, but it was $17. Now that's an iPhone 10 there on the right. That was $1,000 the time I made this presentation. Now, why in the world would anybody want to spend $1,000 on something they can get for 17? I think we just talked about it, is there's a lot more options and tools. In fact, most of us in this call, Dee, before we started the recording, was just talking about how she had some technology issues with the phone this week. We will gladly spend $1,000 for one of these because, in fact, we'll probably do it every 3 to 5 years because we need another one. And there's a reason why, is because it's become such an important tool of our life and how we use it. We can't imagine life without it. And that's how reverse mortgages are. When I learned the facts on these things, I started realizing, wow, the only negative that we'll talk about today about a reverse mortgage is they're more expensive than a forward mortgage. And that reason is because of the cost of FHA's mortgage insurance. And we'll kind of go through that more in a minute, but mortgage insurance is a key nasty word. I always thought, well, why would anybody want mortgage insurance? That's why I put a bunch of money down on my house. That's why I would never pay for that. That's a fool's insurance. Nobody pays mortgage insurance. And that's the truth on a forward mortgage. On a forward mortgage, you want to put enough money down. It's generally 20%, and you get out of insurance. You get out of paying that for that policy for the bank. Now that's different on a reverse mortgage. They don't correlate at all. Mortgage insurance on a reverse mortgage is what makes this product such an amazing product and keeps the user, the borrower, protected and protects how this whole program works. And we'll talk about that. I always like to start out, and anybody that's not muted or anybody wants to come off mute, I'd like to just start out this class all the time when I teach it on why in the world would you not want to get a reverse mortgage, or why would you not recommend one? Dara, you started out saying, I try to tell people about these all the time. Why would somebody not want a reverse mortgage? What's the elephant in the room?
They're afraid they're going to lose their house.
Bingo.
Yeah.
But that's the top one, right?
Mm-hmm.
That's the one. That's the elephant in the room.
You'll get part of your money and then you'll die and somebody else will get the rest of the equity.
Good one. That's true. Those are my two. Those were my two as well.
Yeah. And there's a sub one to the first one, which is I'm not going to leave the legacy, right? I don't leave something to my children. And that's a different issue, but still one we have to work through, that people need to understand it's okay to be selfish and plan for your own care. And that's just another issue we see too.
Good. So those are three. One, the most common, right, is I'm going to lose the house. Okay. Two is, like you're saying, is I want to leave a legacy. I want to leave my house to my kids, and this would stop that. And then three I'm going to borrow some money, and this debt, they're going to take my house because I borrowed some money from them. And those are all kind of related, but it's so true. That's the very things that I thought That's like I said, when we started this, I told my grandfather, you're going to borrow like 30 grand and you're going to die. They're going to take your house. And that's how I thought they were. And that's how I think a lot of people do. But let's talk about those facts today. Every one of those things that were said are just not true. And I want to tell you and give credit to where credit is due. This class I'm going to go through today, most of this info came from Dr. Wade Pfau. And as you can see, he's a smarter guy than me by looks and his credentials there. His bio is a little better than mine. This guy's got a PhD. He teaches financial advisors at the American College. So he is a professor to teach financial advisors. He writes books and he is a genius as far as I'm concerned. The guy is, he's totally analytical. He doesn't have a sales skill in his body. and if he's ever watches this, I think he would agree. He would give you a thumbs up there. He's not really a salesman, but he definitely is really, really smart and very good at articulating complex. He doesn't just talk about reverse mortgages. So anything, he talks about annuities and insurance and a lot of these red flag items that people don't want to talk about, complex ideas, and he breaks them down to a very simple way. And let's talk about the simpleness of what a reverse mortgage is. Well, first of all, you have to be over 62 years old to get a reverse mortgage or married to somebody that is over 62. That's a big change. The reverse mortgage product has got a lot of negative press over the years. One of them was saying that, I got kicked out of the house when my husband died. A wife would inherit a home and she wasn't on the loan and she had to find a new place to live. The reason being is back in the day, if you were under 62, you weren't protected by this mortgage. That's not the case anymore. As long as one of you is at 62 years old of age when you take the mortgage, the other spouse is protected and gets to stay in the home all the days of their life as well. Now they have a few qualifications. They have to pay the taxes, the property taxes, and the homeowner's insurance on the property still, and then they can stay in the home. Now, let me give you a little secret. If you pay your house off cash, you still have to pay your property taxes, because if you won't, they're going to come take your house. I can promise you, okay? That has nothing to do with the mortgage. Second, if you don't pay for your insurance and your house burns down, you don't have a house. So you're going to pay those two things anyway. So that's just, people always say, well, I have to pay these. Well, yeah, you got to pay those. You got to pay those anyway. So I'd like to give my own story. My house is paid for. I don't have a mortgage. That doesn't mean I don't agree with mortgages. We'll talk about today, but I still have to pay my property taxes. Now, I live in the state of Idaho. In Idaho, if I get 3 years behind on my taxes, they will sell my home at auction to pay those. And when I say they, the county. So I live in Ada County. They'll come sell my house and somebody else will own my house for whatever the property tax bill was. That's just the facts. And so you got to keep paying those. It has to be an FHA qualified home. And what an FHA qualified home is there's a list I'm going to show in a minute, but it's a single family up to 4 units. And it's this house that's safe and clean and doesn't have a bunch of underlying issues. This is not for fixer-upper homes. This is for homes that are safe. They have a good roof, a good foundation. There's no electrical issues. So, if somebody ever gets concerned that their house won't make FHA requirements, we can fix the house to qualify. You can actually fix the house with the equity in the home and help the house to qualify. So I've had to do that before. So it's something that can be done. You must live in the house as your primary residence. That's a big thing. So this is where you live as your home. So if you have a house here and a house in McCall, and you're saying, I'd like to put a reverse mortgage on my house, I would say, well, you have 2 houses. So which one do you live at more? Which one is the 6 months in a day house? Which one is more than the other house? And that's the house we would put it on. Now, when I say generally won't affect Social Security and Medicare benefits, it's not income. We'll talk about that. So if you're going to take income, if you're going to bring in cash flow from your house, it's a loan and it's not income. So it won't affect your Medicaid, Medicare, or Social Security benefits. But if you take a bunch of cash out as a lump sum, it could. So in other words, if you have 100 grand equity in your home and you take the 100 grand and you put it in your checking account, that's why there's an asterisk there. Is yes, that could have an effect because you brought it in as an asset now. By bringing it in slowly as income though, it won't affect those things. you get to keep the title to your home. Now, this was probably one of the biggest misnomers to me. I thought you signed the bank over to the house. You signed the house over to the bank. Forgive me. That's not the case. You keep the title. We put a deed of trust in place, no different than a forward mortgage. And we'll talk about that a little more in detail. But the thing is you keep the title. Basic credit and income qualifications are required on this loan, just like any other loan. Now, we don't necessarily on this loan care about credit scores and things like we do on a forward mortgage. I've done this loan for people that do not have credit scores at all. I've done them for people that have terrible credit scores because the credit score doesn't matter as much. What matters is, are you over 62? Do you have enough equity in your home? That's more important. But we do look at those things. We look at those to make sure that you can pay your taxes and your insurance on time. Because what matters is, can you continue to keep your taxes and your insurance current? And here's another red flag. I watched a video one time of Dave Ramsey. He had a 94-year-old woman on his program saying she was losing her home because she has one of these terrible reverse mortgages. That went right past my head, went right to my heart. And I said, yeah, that's why people don't do these. Good job, Dave. The problem is, when he goes in further to the story, he talks about how she hasn't paid her taxes and they're going to foreclose because she's behind on her property taxes. Well, that has nothing to do with that mortgage. But see, I didn't stop to go look it up. I didn't stop to look at the facts. What I did is listened to the fact that this lady's losing her home, and that wasn't the facts. The fact was she was losing her home, nothing to do with the mortgage at all, everything to do with the property taxes. So again, we want to make sure that doesn't happen. So FHA made some key changes. And this happened in 2014, where FHA said from here on out, you have to prove that you can pay your taxes and your insurance on time. And if you can't, we're not going to let you do this mortgage. We're going to stop you, or we're going to make you put some cash aside to pay the taxes and the insurance for you. So when you take money out of the house, when you take money as income, again, it's not going to be labeled as income because it's a loan, but it is cash flow. It's money coming into your home. It's going to be tax-free, because the government doesn't tax a loan. And you can get equity depending upon your age, anywhere from 30 to 74%. The older you are, the more equity you can extract from your home. Why? Because it's a mortality-based product. If somebody is up there in years, let's call them 90, they're going to get more money than somebody that is 70 because they are closer to passing away. They're closer to paying back the debt. You'll never have to make a monthly payment, okay? But you still have to pay those taxes and the insurance and HOA fees if you live in a subdivision with HOA fees, okay? So your payment is made 1 year after you die or within the time frame or you want to leave the house. So let's say you want to sell your house. Go ahead, sell it just like any other mortgage. You'll have to pay off your debt. You can go buy another house. Let's say you want to leave your house to your kids. Dara, you brought that up. Well, your kids will just have to pay off whatever debt is there and take the rest of the equity that's left in the home. So, let's say the house is worth $400,000 and they owe $200,000, then they would sell the house or refinance it either way and pay off the $200,000 that's owed, and they would, obviously have the other equity for themselves. So that's stuff I didn't understand, but that's the facts. That is not my opinion. That is the facts. So you can sell the property. Now,
And the family gets the first priority to refinance. Is that?
They do. Good question. So they have 1 year. They have 6 months if they don't ask for any extensions. But if they ask for extensions, they have 1 year in which to sell or refinance the home. And they can do that in a forward mortgage or a reverse mortgage. So let's say they're over 62 and they want to live in the house as their primary residence, they could possibly do a reverse mortgage. But if they did a forward mortgage or regular mortgage, a HELOC or any other type of mortgage, they would take that and pay off the mortgage. Now they'll have a year in which to do it. Now here's a wonderful thing. They don't have a mortgage payment to make personally while this is happening. They have time. But if mom or dad had a regular 30-year fixed, 15-year mortgage, whatever, regular Fannie Mae, Freddie Mac mortgage, guess what? They have a mortgage payment to pay next month, because if the payment's not paid, well, they're going to start the foreclosure process pretty quick. So this gives you time in which to get affairs in order. So the loan is simple. What if I offered you a loan that allowed you to make payments if you want to, optional payments You can make them anytime you want. You can get back to the money you pay anytime you want. And you don't have a payment that is forced to be paid until 1 year after you die. That's a reverse mortgage. Nobody's forced to make a payment until 1 year after death or 1 year after exiting the home. So you have time to get your affairs in order. Like people say, well, what if I go to a nursing home? Well, that's fine. Same rules apply. You're no longer living in the home. At that point, you probably don't need the home. So at that point, the house would be sold and the equity would be distributed as you see fit.
But even in that scenario, I'm sorry to interrupt, but even in that scenario, the children would have the opportunity to refinance it to maintain the home, correct?
If they want to. Mhm.
Yep.
They could.
I mean, it's a choice. And I think that's the thing that when I hear people saying my children won't get my house, in all of these cases, you have a choice to make and you've just had access to the money, I think is really where I try to help them understand.
No, it's very good. And as we go through, you'll see that more. I had a financial advisor 2 weeks ago when I presented to his clients. This is what he said. He was against them. He was totally against them. We went through the presentation and a light bulb went off and he was like, this is amazing. He goes, this is like getting an ATM machine right in your own garage.
Yeah.
I said, I'm stealing that. I like
Yeah.
that.
It's a great analogy. I'm like,
Yes.
I keep telling people I'm not old enough, but I know what I want for my birthday when I turn 62. You know,
Well, we're the same. We're the same. See, I have a house full of money right now. I feel the same way. And it's locked up into a vault I can't touch. See, if I go touch the money at 43 years old, if I go take a loan, Steve Cox, who's on the call here, he does lots of forward mortgages every single month. If I come to Steve and said, Steve, let's take a mortgage against my home, I'm going to have a payment that's called a forced payment, right, Steve?
Correct.
I'm going to be paying back payments next month. And if I die, my wife has a payment next month. I don't like that kind of mortgage myself.
Yeah.
Yeah. To me, that's the loan that I should be scared of, right? Because it's full recourse. In other words, if I borrow money, let's say I go buy a house today. Would we all agree that the housing market's high right now? Right?
Mhm.
Well, I can tell you factually, it's never been higher in the history of the world. That's the facts. So if I went and bought a $500,000 house, let's say, and Steve, could I borrow $500,000 for the most part? I could borrow most of that from you to buy that house. I don't have to put very much down on a forward
Sure,
mortgage.
correct. Mhm.
Now, would you agree if I borrowed, let's call it even 480? I go borrow 480 of that and the market tanks and goes down. I still owe 480.
Correct.
That's a traditional mortgage. That's how it works. Now, if I can't pay you back and I stop making payments, they'll foreclose the home, right?
Mhm.
And they'll come and sell the home. Now, if they don't get their 480 back, what will they do, Steve? Will they come after me for the difference?
Absolutely.
Right. They will, because I signed a personal guarantee said I will
Right.
pay. See, that's how mortgages work. But that's the thing. A reverse mortgage doesn't work that way. Reverse mortgage says you can't come after me for the difference. In that same scenario, they could only take the house. And that's why people think you could lose your house. Well, yes, if you can't pay your debt back, they're going to take your house to get the debt on any mortgage. But guess what? On a reverse mortgage, they can't come after the shortfall. I told you I would stop later and talk about this mortgage insurance. The mortgage insurance is what ensures the fact that FHA can only get paid back by the house. And if the house can't pay, guess what? They will eat the loss. FHA will. They won't come after the borrower or the estate or the kids to get paid. That's a difference between a forward mortgage and a reverse. A forward mortgage will come after the assets owned by the borrower to get paid. So it's an FHA loan. It's a non-recourse loan. It's insured. And the biggest key factors I want people to understand on this mortgage is what Dara just really hit on. Options. Remember that cell phone has options, right? We may not use them all. Okay. I've never been on Instagram, Facebook and stuff. I mean, I've been on Facebook. That's not true. But I've never been on like Snapchat. I don't know what that is. My kids have so many stuff on here. What's another one they use all the time? TikTok. I've never
TikTok.
been on it. I'm not gonna lie to you. I've never been on it. I know what TikTok is, but I've never been on it. That doesn't mean I'm gonna throw my phone away. Okay? There's lots of things I use this for. Now you may have used all those things, but to me, Facebook's as far as I go, and that's about. And it has so much political stuff on it. I don't go on it too much anymore either. But the point is, those are options that I have available to me. I paid for those options. This loan gives options. And these are the types of houses we can put it on. 1 to 4 units. So if somebody wanted to live in 1 unit and rent out 3 units, imagine having a mortgage that doesn't require you to make a payment. You can rent out 3 other units, and those 3 units were empty because of, or you couldn't collect. Let's just say we got into this crazy pandemic and they said, you know what, you can't collect rent for a while. Let's just make up some fake scenario. And on this fake scenario, you can't collect rent, and the actual US government doesn't even allow you to do so. And if you're on a fixed income, do you think it might be a little difficult to make a forward mortgage payment? I think so. On this loan, no payments due. You could still be okay. So you could actually rent out 1, live in 1 and rent out the other 3 units. And when they're empty, guess what? Still no payment. Now you get a statement every month on this mortgage, just like any other mortgage. But the statement that comes, any payment you make is optional. You don't have to make one. If you do, you can actually get back to the money. So let's say you wanted to make $1,000 payment, just for an easy number. All $1,000 you can get back if you want to, because it goes into a line of credit. So if anybody's familiar on this call with a line of credit or ever had a home equity line of credit, maybe a HELOC, that would be the term we'd use. Many people are familiar with those. So I like to bring up product we already understand. So since we understand a HELOC and we can borrow money and pay it back, borrow money and pay it back in our house, the difference with a traditional HELOC is, guess what? It has a forced payment. Again, it also has full recourse. Most HELOCs are done in second position, but not all. But you're borrowing money that has to be paid back and paid back right now. And it can be called due or changed or altered based upon what the bank is experiencing in the economy. I don't know if anybody realized this, but just back in July here of 2021, Wells Fargo, the second largest bank in the entire world, decided to call due and accelerate the payment on $24.9 billion worth of line of credits. They said, hey, by the way, we're going to shut those down. We want to get paid back. And we're going to give you 60 days notice because we're good people. So that was a good notice, but you had 60 days. And that's happening right now. And if you don't believe me, Google it. Happened in July of 2021. And this is recorded, so it'll be here for all time. And I will tell you that happened. And go back in 2007 when the market hit high. If you ask anybody that had a HELOC in 2008, 9, and 10, many of them, Dara's raising her hand, they got shut down. Banks just said, look, we're calling those due. We're shutting them down. We're accelerating the loan, whatever fancy word you want to talk about. Basically, they said, you can't use it anymore. Pay us back.
And we had to refinance to pay it back.
There you go. And what was happening when you had to refinance? Was your value of your house going up or down?
Oh, it was horrible.
Right. So the house is going
horrible.
here, and they're saying, pay us back with something that's not there. And some people couldn't do it. Some people say, I can't refinance it. I don't have the equity to do so. You were lucky where you could. But a reverse mortgage can't do that. FHA ensures that we'll never alter or change that line of credit. It's non-recourse. So guess what? Even if the market goes down in half, which it did from 2007 to 2011, the market dropped in half. That house you had, Dara, would you agree it dropped in half in that time? I know mine did.
Yes.
And when that happened, if you had an FHA HECM loan, home equity conversion mortgage, fancy way to talk about a reverse mortgage, that's what it is. But if you have a FHA reverse mortgage, you can't have that change on you. Your line of credit is still available to you, even if the housing market drops in value. That's amazing. It sounds too good to be true. I have people all the time to me say, okay. I was against them. You convinced me, but now they're too good to be true. How did they make money? I don't get it. And it gets that all the time. We'll go through that today. But I will tell you, it's not too good to be true, but it is too good to be free. I told you they're expensive. I started this whole class with that. This insurance is not cheap. It's going to cost 2% of the value of your home to protect and keep this product alive and working well. That used to be 0.5% of the value of your home until in 2017, a very wise man named Ben Carson was appointed. I don't care what your politics are, but I'll tell you this much. There's a guy named Trump. You may or may not like him, but he was our president, and he appointed a very, very good guy called Ben Carson over FHA. And this guy's a neurosurgeon, so he's not like, some He's a pretty smart guy. And he decided that, looking at the facts, or the 0.5% that was going into this kitty wasn't enough, because there's 78 million baby boomers. There's 10,000 of them turning 62 every day. Okay. So he's like, look, we got to get some more money in this kitty of money, because it's not a matter of if, it's a matter of when. When this market corrects and goes back down, if too many of those people die and they're upside down in their homes, FHA is not going to have enough money to suffer these losses. So they raised it from 0.5% to 2%. Well, that's a 4% increase. I mean, fourfold increase. So you're looking at a big difference. So if you have a $400,000 house, you went from paying $2,000, paying $8,000. So $8,000 is that 2% of 400 grand. And that's a big deal. So you take this $8 grand and people say, well, man, this loan's going to cost me $8,000. And you start looking at the fees and you start looking at the expenses, and you have to see that it's not too good to be true. There is a cost to it, but it is a great product, and everybody should be educated on them. I didn't say everybody should do one. I said everybody should be educated on them. So I think we're missing the boat here. We're missing it so big. Let me give you some perspective on this call today. Fairway Mortgage. I'm not trying to be on this call to toot our own horn, but we're number 6 in the nation in loans. So we're number 6 in the forward mortgage space. We do about 18,000 loans a month. Okay. Those are 30-year fixed, 15-year mortgages. Those are regular everyday mortgages. Okay. About 18,000 a month. Probably the largest company you never heard of. Okay. So we're pretty big. Okay. Your first place, you've heard of them. They're called Chase. Okay. Wells Fargo is number 2. You've heard of them. Okay. These companies do hundreds of thousands of 30-year fixed and 15-year mortgages every month. So you heard that correctly. In the entire nation, every company combined, there was 35,000 reverse mortgages done last year. 35,000. Okay. This year, we're on pace to do about a whopping 40,000. Okay. So think about that for a minute. In perspective, Fairway, little old Fairway, 6th in the nation. We're going to do more forward mortgages in the next 2 months than the whole industry did in reverse mortgages last year. So there's just not enough education. We need to get this type of information out there so people know the facts, because guess what? There's a huge epidemic coming our way. There's not enough people there's people that are retiring, these baby boomers, these 78 million plus, don't have enough money to retire. They don't have enough money to live on the income that's going to come in. There's already issues that we know coming forward with Social Security. There's issues ahead of them, and not enough money to sustain the lifestyle they'll need. And many of them are going to outlive their money, because they're living. I mean, Dee could speak to this, because how many people that their bodies are living healthy longer than they expected, and then the mind kicks in, maybe doesn't work as well. Okay, we're seeing a rise in obviously dementia and Alzheimer's. Why? Because we're good at keeping the body alive right now, but we're still haven't 100% figured this one out. But here's what happens is people had financial plans to live to be 75 to 85, maybe tops, but they never in their wildest dreams thought they were going to live to be 90, 95. And that's happening more and more every day. You know what? I've never had somebody come to me and say this. I've never been at a wedding ever and seen the 2 people walk up on stage, hold each other's hands and say, I can't wait till we get divorced. I've never been to a wedding and seen that happen. Okay. But and that would be terrible to hear. But I have heard this saying, which would be so foreign, the exact same thing. I've had people come into my office and say, I hope I die before I run out of money. That should be as foreign as hearing that at a wedding to me. You're sitting with a financial guy that was trying to help you, and they're saying, I hope I die before I run out of money. I hear that way too often. I think everybody in this call has experienced or had someone in their life that felt that way or said that.
Well, and I think the other piece that goes with that, Shane, that I hear all the time, and I know Dee does as well, is I don't want to be a burden. And to me, this is one of those things that if you're worried about that, this is one of those options, choices you should know about to help you fulfill that desire to not be a burden potentially.
I agree. I think a lot of people don't want to be a burden on their kids so much that they suffer. I had one lady that I worked with, I could go through story after story, but she was drying her toilet paper and reusing it.
Ooh,
That's
Wow.
heartbreaking. That's heartbreaking because she didn't want to be a burden to her kids. And she wanted to leave her kids a legacy. And she wanted to leave something. And the only thing she had left was the house. She was so emotional about spending any money from that house. And I use that word spending money because people don't understand. I'll give you an example. We're going to talk about this on a slide that's coming up, but I'll point it out here. When people talk about reverse mortgages, many people think, they don't understand them. So they say things like this. My mom had one of those terrible reverse mortgages, or my grandma had one of those terrible reverse mortgages, and they took her equity, And when she died, I hardly got any money out of that house. I would never do one of them. And that's the stories we hear. But see, they didn't understand how the reverse mortgage works. So that's their perspective. So that would be like saying this. My mom had one of those terrible 401ks. You know what? She saved her money in that thing her whole life. And then when she retired, you know what she had the gall to do? She spent that money, and she did. And she traveled, and she bought groceries, and she bought gifts for her kids and grandkids. And when she died, I hardly got any money out of that 401k, and I would never do one of those. But to me, we laugh at that because that's stupid. Because we all understand how a 401k works. We know mom saved her money to spend it. But guess what? Mom has the right to spend the money she saved in her house too. In fact, she probably saved more money in her house than she did in the 401k.
Yeah, right. Better
Yeah.
return.
That's right. And a safer return. It was a compounding return because I understand how money works. So I'm going to go through this bucket. This bucket here, I've made a
Hey.
separate. Yes.
I had a quick question about the interest rate. Now you said it was 2%. Is that annually?
So no, the cost, there's two different things. So the cost to do the mortgage insurance is going to cost 2% on the front end of the loan to set up the mortgage insurance. That is a fee, goes directly to FHA. It's a fixed amount on the value of the home. The interest rate on the mortgage, ironically, right now is about 2% too. I think it's like 2.1% today.
Okay.
yes.
So it's a one-time fee.
Yeah, but that one-time fee, now there is a monthly charge that goes into the mortgage insurance as well, but it's only on borrowed money and it's 0.5%. So let me explain that. If somebody like myself has their house free and clear, like my grandfather, we opened it up for a different reason. Just like Dara was saying, on her 62nd birthday, her present to herself, that's mine too. So I want to tap into that equity. But Don, when I tap into that equity, I can actually open up a line of credit. Let's go back to this slide. There's 3 different ways I can touch money. I can do a lump sum, which means I can just get an amount of money in a lump sum, a check, and spend it. That'd be on a refinance or purchase. So if I were refinance, it would be actually taking money out of my house. If I want to go buy a new home, I can put
Sure.
less money down.
Could be taxable if it's a lump
Yeah.
sum.
Well, it won't be taxable because it's still a loan, but it could
Okay.
affect benefits like Medicaid, Medicare type benefits because it won't be a taxable event, but it could affect other things. No matter what, the $100,000 I took out won't be a tax because it's a loan.
Right.
But a line of credit is a better way. Let's talk about a line of credit. A line of credit, let's take somebody like myself. If I were to take a line of credit against my home, my line of credit is available to me. It's available money, but I don't get charged interest on it, right? Dara, when you had your HELOC, the money you weren't using, you weren't getting charged on. You only got
Nope.
charged on the money you used, right?
Correct. Yep.
Same thing here. Here's the difference. On your HELOC, Dara, that you took, if you took $100,000 HELOC, whatever, I won't going to go through your personal life here, but
Yeah.
whatever HELOC you
It
took,
wasn't that big, but yeah.
yeah, but they didn't give you more money, right? When
No.
you opened that HELOC up, that was the most you got.
Absolutely.
Started at that balance. And on a reverse HELOC, we open it up and it gets larger the rest of your life. So if you open up $100,000 line of credit, and every year, if the rate is 2%, we're going to let it grow by 2%. So we're going to let you have 102,000 next year. And after that, we're going to give you 102,000 plus interest on that the next year. So you're looking at, sorry, I was going to mute Steve there. Just put his hands up in the background. Mute him real fast. There we go. So the thing is when you look at this, guys, it's a line of credit that grows. It allows you to have access to money today and in the future, access to even more money.
If you
Now
don't
that-
touch it, right? If you keep that principal, it'll continue to grow.
That's correct. Now, if you touch it, then it's your debt growing. So in other words, let's just use an easy number. If you borrow 100,000 and you take the 100 grand, well, next year at 2%, you would owe 102,000. And the interest then would grow on the 102 and you would be at 104 and change the following year. And that is really easy for people to understand. That's obviously how it works. Now that's called reverse amortization. Okay. That's where the product gets its name. Forward amortization, we're all familiar with. In other words, is anybody here by a raise of hand ever had a 30-year fixed mortgage before? Now, were you shocked to know that we threw all the interest in the front of that loan? Right? We stuck all the interest in the front of the loan.
Wasn't surprised, but I wasn't happy about it.
We're happy about it. But Don, you knew that's how it worked, right? That's why
Oh, yeah.
Dave Ramsey and people say do a 15-year mortgage. Why? Because you get ahead of that bell curve. Because if we take a 15-year mortgage, we know that we're starting to pay it back right away. We're
Right.
paying more principal than interest. Now, a reverse mortgage works like that in reverse. At the beginning, the 100,000 only went up to 102. It doesn't grow very much, then 104. But interest upon interest upon interest upon interest, guess what? 15 years down the road, it's going to start getting to be a larger number, right? Because
Yeah.
it's compounding interest in reverse. So that's understanding how that works. So that means unused money, Dara, is a big deal. If I open up a line of credit at 62 and I don't need the money yet, and I let that grow, that number is going to get larger. It's going to compound. Now, I always tell people, would you like to start investing when you're 18 years old or 40 years old?
18.
18
Right.
every time.
Right, because we know the compounding interest. So that's the same thing. It's like being 62 or starting this at 85, 90. Well, I want to not wait for the loan of last resort. See, most of people use it as the loan of last resort. When they get to 85, they're like, I'm out of money. I outlived it. I got to dive into that house. And I was planning to save that for the kids. And guess what? I always ask them, your kids want your house? They're like, well no.
Do they want to live in the house? They might want the
Yeah.
money, right? But do they want to live in the house?
Yeah, exactly. I'll ask it this way. And they'll say, yes, my kids want my house. I'll say, okay. So you mean your kids are going to move into your house from the day you die? Well, no, they're going to sell my house. You mean the kids want the equity? So that's two different things. So let's talk about that. These three buckets explain that, but I'm going to share a different screen. Share this one right here. We'll give it to you the best that I can explain. This right here is really the key how money works, let alone how. Okay, everybody can see this blank screen. It says job at the top, right?
Yes.
Yes.
So this is just how money works. And this right here will really help you understand how a reverse mortgage plays in life and how a mortgage plays in life. And so when you have a job, you need income. So hopefully you get a job that makes income. That's what the point of the job is. But the assets that you're trying to accumulate over life are things that we need when we retire. And the average person is putting about 15% they're trying to save in that asset bucket over time. That would be, some things are voluntary, some things are not. And we'll talk about that. Equity is if you're a homeowner. So this wouldn't apply to somebody that's a renter because they're not building equity. But a homeowner, they're going to put 25 to 40% of what they make into that bucket. I think this is why this bucket is so precious to people. When we talk about it, people are like, do you know what it cost me to pay that thing off or pay that down? It was huge. They wrote the check every month. They felt it. It was a tangible thing. And the debt to income ratio, if you look at historically, it's moving higher. For me and Steve that do mortgages, all different kinds, we're seeing a lot more people get up to that 40% number of what they make for housing because housing is so expensive right now. All of us understand that. But see, when income is so important because we need these items. We need to eat, we need gas, we need living expenses. Those are things we need. And when you're working, the income comes in that way, and that's how you pay for those items. The assets we're putting money into are things like Social Security, savings, and all these items here. Well, Social Security is one of those involuntary deals. I didn't choose to put money into Social Security. I don't think anybody in this call said, you know what, I'm going to just decide to do Social Security this year. They take it, okay? It comes right off the top. And that's why I don't think people feel it as much, is because it comes off the top of their pay, okay? Even if you're self-employed, you might have wrote a check for it, but you didn't have a choice in the matter. But people that work at a job, a W-2 job, they don't even see this. It's taken before they get it. And same thing with pensions. Pensions are another one of those items that are kind of a forced item. Now, not everybody has pensions anymore. I think if we took a poll on this call, we might have one of us. I mean, very, very few people have a pension anymore. It's getting less and less. There we go. We got D. Curious, does anybody else besides D have a pension on this call? So there we go. So that we're par for the course. Okay. Now those are becoming less and less, and the ones that are out there are a small portion of somebody's retirement. It's not their full retirement. It used to be, this is how people retired. You go back, 20, 30, 40 years ago, this was, Sears took care of you. You work for Sears or you work for these companies, this is what happened. And then the introduction of the 401k. Okay, now you get into these different type of investments, IRAs. Now an IRA, the individual retirement account, a 401k is an IRA. It's just section 401k of the tax code speaking to how the IRA works. Now there's rules on when we can touch the money. Okay, there's rules on when we can touch the money and how we have to start taking money. And most people don't understand this, but let's just talk about that for a minute. Why would we have the rules for you have to start taking money out at age 72? Because not all the money is yours. Some of the money is theirs. And if you notice, theirs always spells the IRS every time. Okay. Every single time. Okay. The IRS wants their cut. And when you're 72 years old, they're going to make you take money out of that 401k or the IRA because they want their cut. And it used to be 70 and a half. They changed it this year in what I call the Not So Secure Act. And if you are one of those people that are technical, it is the Secure Act, yes. But it's the Not So Secure Act because you read a lot of it, there's some things that weren't so secure. And one of them was this change. They want their money faster. And people say, well, they moved it from 70 and a half to 72 years old, so they want it slower. No, there was a trick. That year and a half, they said, for this compromise to move it out a year and a half, we're going to get it faster from your kids. Because when your kids inherit it, now they have to pay us all our taxes within a 10-year period. That's a big deal. Used to be over their lifetime. If you're 43 like me and you inherit $1 million, let's say from a grandparent or from a mom or whatever, I would have the rest of my life to spend it on the old rules. Now I would have 10 years to spend it. Well, I make decent income. Can you imagine adding $1 million over my income over the next 10 years? Theirs is going to get a whole lot more money. And theirs is going to get it a whole lot quicker. And that's why they did it. So whenever you want to see why the government made a change, remember, theirs always spells the IRS and they want theirs. So understanding that when you take money out of this bucket over here, like we just talked about, when I'm 62, I can get that ATM in my garage. I can get money out of that bucket that I've saved in, which is forced upon me my whole life. And now I can get tax-free money and turn any payment on that mortgage into a voluntary payment. That's huge. Now I can tap into that asset and I don't have to make a monthly payment to return the money. That changes everything. Now, understanding that when I lose the job or quit a job or retire, let's talk about retirement. When you retire, the job and the income change. Now I got to live off of 2 buckets of money, either my assets or my equity or a mixture of both. Most people only concentrate on the asset bucket. They don't understand the facts about equity. That's why there's only 35,000 reverse mortgages done last year. People don't understand this. They understand the assets. That's why we don't hear the granddaughter come and saying, my grandparents had one of those terrible 401ks, because they understand them. Okay. Now this bucket of money has rules on how we can touch it, but it also is almost always taxable. Let's talk about that. Outside of a Roth IRA or outside of a cash value life insurance policy, when you take money out of those assets, theirs is getting a cut. So when I come to financial advisors or I'm talking to people, I say, do you think you can earn 4 to 5% conservatively on that bucket of money? In other words, between your pensions, your Social Security, your IRAs, and all your investments, do you think you conservatively average 4 to 5? And I never have anybody tell me no, because I got these numbers from advisors like, well, yeah, conservatively, even in our low interest rate environment, we can earn that kind of money. Now, here's the thing. I always ask them, when I take the money out of that account, is it going to be taxable? And they're like, yeah, it's going to be taxable for most of my clients, every dime. Now, and when you touch that money, it's probably going to cost you more taxes, not just on that money, but taxes on your other money. Because, if you make too much income, your Social Security is going to start getting taxed. And you can tax that up to 85% of your Social Security. That's a big deal. And so how you touch money. So when you turn 72, a lot of people don't have a plan for that. Those RMDs, those required minimum distributions kick in, and it greatly affects their taxes. Now, we just talked about this. Don, you asked a question about interest rate. Interest rates right now are in the low 2s, but right now on a forward mortgage or reverse mortgage, you can get rates in the 2 to 3% range. Okay. Now, when I take money out of here, guess what? It's always tax-free. So I'm going to ask you just a straight up question. I'm going to pick on Don. Don, do you think it'd be better for me to take money that cost me 2 to 3% that's tax-free, or would it be better to take money that cost me 4 to 5% that's taxed?
I think I'd take the tax-free money every time because I don't know what the
Exactly.
tax rate's going to be.
Exactly. See, that's a common sense, but see, we have to see it this way. People don't know the facts. This is why we need to educate, not people that are 62. I want to teach people that are 22 this, because we're waiting too long to teach people how money works. This is the facts. This is not about how reverse mortgages work. This is about how money works. This bucket of money that we have here is a great asset to use. And if we're not using it, we're actually going to pass less money to our kids instead of more. We're going to pay more money in taxes, and we're going to have
interest.
less money ourselves in retirement.
Yeah.
So think about that for a minute. Do you want less money in retirement or more? You want to pass more money to your kids or less? And do you want to give more money to the IRS or less? I mean, I know the answer to all those for me.
More,
see
more,
that-
and less.
So when I look at this, I always say, listen, well, this is a no-brainer. I mean, it's a no-brainer. You should definitely be using your house as a strategy to save money, pass more money. So when people say to me, I want to leave as much to my kids as possible, I'm saying, great. Then you must understand how this equity works and how to use it so we can pass them the most money as possible. And I've had a lot of people come to me and say, I want to give my kids the most money I can. And I don't ever usually miss a beat. I say, okay, then it's probably best that you die right now. And it's sad, but it's true. Because guess what? From here on out, you're going to be spending money because that job went away and the income's no longer come there, it's come from here. So unless you have enough money to live on what I call that asset bucket. I have another presentation where I call it a cow. Okay. You can live on milk and cheese, but you can't live on beef. Okay. If you have enough money in there that we can just live on milk and cheese, then you can leave quite a bit to your kids. But guess what? Cows don't stay alive if we live off beef. We can't be diving into the beef. We can't be diving into the meat. We have to just live on the milk and cheese. And we all get that, right? And so that's the thing is, what if I have a place to go get money when the market's down? And I told you, I talked to you a little bit today about Dr. Wade Fowler and what he did. Let's talk about that real quick. But when you are doing this and you understand how this equity works, the equity that's in your home is a tax-free vehicle. And guess what? Even if the market goes down, you can still access the money. And being able to access that money when the market is down is the key. Because when the market is down, you need to have a place to go get money. We call that a buffer asset. Because when the stock market drops, guess what happens? So when the stock market is down, when the stock market is not having a return, let's go back to March of 2020.
Mhm.
In 4 days, the market dropped about 25%. Well, if you had this money in the stock market and your mutual funds and your IRAs or whatever, and you needed money to live on, guess what? You needed to sell to get you milk and cheese. You probably were having to get some beef. And what happens is you're selling stock when they're down, and then you have no way to recoup those assets. They're sold, they're gone. And when you're on a fixed income, when you're in retirement, there's no way you can repair that kind of loss. And that's why you must have a place to go get money. Now, having ability to get to your equity, like Dara was talking about, me, when we turn 62, that's our birthday present, man. We can't wait. Now we have a way to tap into money, even if the accounts, our other accounts are down. What this allows us to do is strategically take money from the best bucket of money at the best time. So in other words, there's times I'm going to take money from my stocks and my bonds because they're way up and they're great to take from. And I need some tax deductions or things. So we can talk about strategies. options was the word Dara used, the same, we have options because guess what? We brought in a whole toolbox of them and I could go on and on, but today this is more of a level of a class just to let you know the facts about how reverse mortgages work. And, obviously we'd love to sit down with anybody and take them deeper level into this because we can bring in your actual numbers, we can run real scenarios and show you how this really works and how it applies to you. But to understand it simply is if I offered you a way to tap into an ATM in your garage that allows you to touch money when you need it, tax-free, so that you can have a better retirement, pass more money to your kids and give less money to the IRS. And then reverse mortgages for you. It's really that simple. So hopefully you guys got a lot out of that. And I know there's any questions. Let's start going through them.
So Shane, what if you're not in the house that you think you're going to spend the rest of your life in?
Good question.
Wonderful question, Dee.
Thank you.
Then here's the thing. I tell people it's a 3 to 5 year commitment because you have to make sense of the fees. So depending on a person's tax bracket, depending on the options they need in their life, what they'll do, you got to keep it at least 3 to 5 years. So it's not meant to be a short-term loan. But let's say, for example, that you did this loan and 3 years from now, you said, you know what, this isn't the house we want to downsize, upsize, whatever. You're not signing a contract that says you can't sell your house. You can sell your house anytime you want. You just have to be able to justify the fees. So I would try to get people into the forever house if we can, because it's better, because that compounding interest on the line of credit is going to allow you more time for that to grow. So ideally, get into the home that you want to be in for the rest of your life. But at minimum, 3 to 5 years, you got to stay in the home. Is there any other questions?
So you're saying that the reverse mortgage line of credit is a better way to go than the loan of last resort reverse mortgage?
For sure. I mean, the loan of last resort reverse mortgage is something we must stop because people are spending money incorrectly. Let's use that example. Most people that come to the loan of last resort means they spent all the other assets they have. They're down to no other choices. Well, what happens is they didn't have a way to preserve that money because they were spending that money out. We should have been spending the money out of the house first to let the other money grow. And so we have to teach people to quit doing it that way. If you look at Dr. Wei Fao's research, he's run tons of real life scenarios and he does thousands of Monte Carlo scenarios in his book and in his research. And every single time, not one time, every single time a person dove and took money out of the reverse mortgage, they were better off in every scenario. They outperformed the person that waited to take it every time.
And while it's ideal to do it that way, I will say that that loan of last resort for that woman who was drying her toilet paper was an absolute lifesaver, right? And
Yes.
whether it was that allowed her to live a higher quality of life or to stay in her home instead of having to move somewhere else. I mean, that loan of last resort truly is transformational. As long as somebody's educated and they understand what they are doing and what the requirements are and how to use it, especially if they have to navigate the impacts of Social Security and Medicaid. You have to be very intentional and thoughtful, but they can coexist and can be truly a lifesaver for people that are at the end of their life and without assets anymore, without cash flow.
Every word I agree with 100%.
I'm
If I
not
told you the
seeing that.
stories of the people that have been the loan of last resorts, those people, Dara knows me. I'll cry. I won't make it through the rest of the call. So okay, the point is I have had a lot of those. They're impactful to them and to me. Now, I want to tell you something, Fairway. I do a totally different program for people in those kind of needs. The fees that we charge, the things that we do on our end are going to be, little to none. If most of those, I do those for nothing, to be honest. When I get in those scenarios where people got to have one, because it's unfortunate. They're widows or widowers and they're in a bit rough situations. So, obviously I want to help those people, but I want to help them before they're there. I want to help them when they're 45 years old so they don't get there. I mean, that's why I'm a retirement mortgage specialist. I don't want to wait and help people there because that's sad for everybody involved. We're crying tears of sadness and joy at the same time because we realize that person can buy groceries next month and they've been struggling to do that. And that's heartbreaking. But to me, I want to save that person before they have to get there.
before they're at the place where they're having that heartbreak, right? Where
Yeah,
they're,
yes,
yeah.
yes.
Yeah, I'm not saying that either is bad. One's better than the other.
Yep.
But
Yep.
having that option at all, like, that's a lifesaver for those people.
It is. And I call them both lifesavers because I put it this way. When you look backwards, I took one of my clients with one of my financial advisors I work with. We went through and we looked at the tax savings he's going to have. He's going to save about $270,000 in taxes. We cried different tears, but they were both impactful.
Gotcha.
Interesting. Love it. So now I have a fourth bucket of tax-free money available.
That's
Instead
right.
of just, the Roth IRA, paying the tax on the seed instead of the harvest. The cash value life insurance, don't surrender it, take loans. Municipal bonds, if your state has, federally they are, but your state may or may not be tax-free. And now reverse mortgage loans.
Mhm.
Yes, every word, Donna, and I agree with every one of those principles. And most loan officers don't understand the cash value life insurance. They don't understand how to keep things underneath the MEC limit and make sure that we're doing that right. I do. I come from that background. So helping
Maximize the
clients.
op.
Exactly. And so when it comes down to Roth IRAs, obviously I love them. I mean, so we want to plan that, but you got to realize the people that are retiring today, Roth IRA wasn't around in their income bearing years very long. So they don't have much in them. So, the group that's coming up, the 50 somethings, they have good Roth IRAs.
Mhm.
The 40 somethings, we have great Roth IRAs, but you take the people retiring today. I think Dee and Derek could both speak to this. People that you guys are working with and people we talk to every time, they don't really have them. Okay. Very few.
Right.
Yeah, and anytime theirs limits what you can do, like a Roth, you can only put in 6,000 or 7,000 depending on your age.
Mhm.
They limit it because it is a good thing. They'll let you put all you want in your 401k because they're going to get a big
Taxable.
cut.
Yeah.
So
Right.
that should tell you right away whether it's good or not. If they're limiting something, there's probably a reason.
Well, and they limit on income. Like I make too much to do a Roth IRA, so I have to do a backdoor every year. We call it it's called the Congress Roth IRA. They put the law in place for themselves because they make too much as well. So what happens is you put money into a regular IRA and you roll it over the next day. And I've been doing that for years, and that's the only way to get in. But there's more than one way to skin a cat. Like me and Dee, when we were trying to set this class up, we were having first world problems. Same type problem.
Right. Well,
Yeah. Well, I go ahead.
one of the, when we do a geriatric assessment, we're looking at financial and legal stuff, and I'm always checking POAs just to make sure they're right. Somebody threw out a snowball at me once that said, "Oh, you have to have a separate POA for a reverse mortgage." Can you speak to that a little bit? Is that something I need to worry about?
It's true. So here's the thing. It's not about a reverse mortgage. It's generally a specific POA for any type of mortgage. The lender, the title company, you want to make sure you have those ducks in a row. So it's kind of like this. You've gone to a bank before and you thought that you had access to that money, right? This isn't just about mortgages. This isn't just about this. And you walk in with the documents you got from the attorney. They set up a trust. You're like, oh, this is going to work great. And they're like, no, we want our form. So it's more of that. It's there's this great person I know that's so good at getting the stuff ahead of time. And she has this little tool. It's $50. And the best part about this little tool is to sit down with her and go through a one-on-one consultation and begin to put your stuff in order. Because I found out that this 42-year-old guy, with the time I started doing with her, thought he had a trust and everything set up. I didn't have anything ready. None of my banking stuff was ready. If I passed away, me and my wife, my kids were, I don't.
They would have had a mess.
They're in trouble.
Yeah.
They're in a mess. And now they're not. So I would say this, my data diary, plug right here for this. Everybody on this call, if you don't know who Dara Ray is, you need to understand that those questions that Dee just asked are going to come up. People think they have the documentation in order and they don't. So the answer to the question is very simple. If you know you want to do a specific thing, you need to get the documentation for that specific thing. because people are going to look at your general documentation and say, no, you're missing this, this, and this. We want that included. Well, guess what? If mom and dad aren't in the right mind anymore, you ain't getting that.
Well, and what we see usually is that they're going to ask for that specific POA because they want it ticked and tied and on their paper. And so it's just part of their process. If for some reason it didn't happen or that person is no longer available and there's a new POA, most financial institutions will honor that new form, but only after it has gone through a lengthy validation process. And so really requiring that POA is to your benefit to make sure that you have access or your agent has access when they need it.
Agreed. Let's translate lengthy process. Attorneys reading documentation by the hour. You have a title company, a lender, and anybody else attorney you want to bring into it involved. There's two bad things in your life you never want to have involved, and they're generally the same. A politician, okay, and an attorney. And believe it or not, most politicians are an attorney. So that tells you something right there. You don't want any one of those in your life if you can help it. No offense on attorneys. You need one. But you need
You don't
an
want
attorney.
you want
I
you
have
want
an
them
attorney.
you want them when you want them. You don't want you
Yes.
want them
You want
them
the
when you don't
attorney
need 'em.
when you have the say.
when you
on
don't need
when-
them. Yeah.
Yes, not when a third party is reviewing your stuff. You want the attorney ahead of time.
Yep.
Anyway,
Great.
so all the attorneys that watch this, I love you. I didn't mean bad on you.
Charlie or Sandra, either of you have questions that you'd like to ask before we wrap up today's session? I see no one come off mute.
Yeah, they've been awful quiet.
They have. Well, all right.
Oh wait, there's Sandra. She just came off mute.
Okay,
Oh,
Sandra.
and
Oh, I don't have any questions, just a lot to process. So I'll be looking forward to the recording so I can review it again.
And there will be some handouts out on the website too, Sandra.
Great.
I already have the one document that they give to clients is out there. And if it's okay with you, Shane, I'll put your PowerPoint into notes slides
Sure.
so that if somebody wants to watch it again, they can take notes as they go along.
For sure. And we can get them any other information too. If anybody wants any more information, I have Dr. Wade Fowles' book. I have a couple other authors that I really like, Dan Holquist and Harlan Acula, have both written books on the topic that are really easy to read. They're easier than Fowles' book. Fowles' book kind of meat. So if you're looking for more of a ground level, I have some of those books. I put that for free in anybody's hand. If you want to reach out to us, I'll give it to you. So I want to educate people on this mortgage. So I want to put my money where my mouth is and put my actions is there as well. So anybody and everybody that wants to learn about this, I could care less if they do the loan. In the end, I want people to be educated so they're making the right choices for them.
I'll be calling.
Thank you.
I'd love to grab a cup of coffee or some lunch with you.
Yeah,
Deal.
definitely.
You got it.
I
Love
saw
to.
Charlie come off briefly. Did you have something you wanted to say, Charlie?
No, not really. I just was, there was just a lot of information. I'm with Sandra. Yeah, we definitely have to process what we heard and go from there. I do have a curiosity factor, and that is, Shane, what is your fee for doing this?
Good question. So on loans, we make money in two ways on every type of loan. Generally speaking, the money that a lender makes is called origination fees. We get paid a fee to process a loan. And the government on this loan, this is a government loan, FHA, they regulate the fees on this loan. The 2% fee goes to them off the top. And then the fees that are charged after that are the origination fee to a lender and then title and appraisal fees. So obviously, if you're getting a house done, we need to appraise it and make sure the value is there. And then closing at a title company, in Idaho, that's where we close, will be fees. So those other fees are all going to vary on depending on which company you go with, but they're going to be pretty close to the same. The origination fee can be charged up to $6,000. No more, but you can go down to $0. And I've done them 0 and I've done them 6,000. I've done both. And so that is basically based on loan amount, how much you're going to borrow. It's based upon many factors. I bring in another factor personally, and it's need. Does the person really need my help here? So in other words, Dara knows those scenarios, like, the ladies that are in trouble. or men. I'm not trying to be, sexist. I'm just saying, generally speaking, I'm dealing with surviving spouses more than
Women live longer.
yes, yes. And in those scenarios, I could give you some real life scenarios. I've done them for zero because I want to just help them, the person. But in the end, I still need to make a living. I know another person that's a philanthropist on here because you can't make money on a little tool, $50. I can tell you that. But in the end, you're just trying to help people. And so that's what I'm after. I'm going to sit down and look at the person's needs and try to help them.
Excellent. What a great presentation and so insightful. And as
Fascinating.
everybody else said, lots to process here.
Well, I appreciate you all very much. Have a wonderful day.
Thank
And
you,
if you
Shane.
need anything,
Appreciate
again,
it.
reach out. And on the slides at the last page, there does have our contact information. Steve Cox on this call too. We work together. He's actually my branch manager. He understands he's at a high level. Our goal, I'll wrap up with this. We have one goal. It's to change how retirement is done in America. And that's what we're trying to do.
I know how to get a hold of Steve. So.
All right. Thanks so much, everybody.
Well,
right,
thank
thank
you
you.
both, Shane and Steve. Shane for presenting and being a sponsor, Steve for being co-sponsoring this semester or this season of our Learn training. We appreciate you very much. We are going to just let you all know that if you have not joined the Learn mailing list now, even though you registered, we don't add you to our mailing list unless you want to be added. So you must confirm the subscription to continue to receive information about our future education events. And just coming up next Tuesday, we have fall risk prevention with Lorraine Quick, who I had coffee with the other day. She's a dynamic lady, really looking forward to that one. Social Security 101 coming up. Dara and I are really looking forward to doing winning strategies for family caregiving. We have a great game that we've put together. And as you can see, the rest of the schedule, we're pretty jam-packed. So we look forward to seeing you again on future sessions. Thanks so much for being with us today. And we hope to be able to see you again.
Thank you, Dee. Thank you, Shane,
you.
very, very much.
Thank you.
Very, very
Thank you,
nice.
everybody. Bye-bye.
Appreciate it.